You don't need a Wall Street job or a finance degree to build wealth. Instead, the most successful investors rely on a rigid, repeatable system that does the heavy lifting for them. By the end of this video, you will have a fully automated, personalized financial engine. Once it's running, it requires less than 5 minutes a week to maintain. To build this system today, you need 4 things: your latest pay stub, your online banking login, a list of your monthly bills, and the free net worth tracker spreadsheet I've linked in the description. Because this engine is built on percentages and automation rather than fixed dollar amounts, it scales perfectly. It works exactly the same whether you earn $40,000 a year or $140,000. Step 1 is calculating your true cost of time. We need to find out exactly what 1 hour of your life is actually worth to set a realistic baseline for your spending power. Take your after-tax annual take-home pay, let's say $47,000, and divide it by the actual hours you commit to your job. If you factor in a daily 20-minute commute and 10 minutes of morning prep over 50 weeks, that yields about 2,250 hours. Divide the two, and your true hourly wage is exactly $20.88. Now, apply that specific number to your purchases. A $200 dinner equates to nearly 10 full hours of your actual working life sacrificed to pay for it. Measuring prices in hours instead of dollars breaks the habit of impulse buying. When you evaluate the physical time required to afford an item, your brain naturally filters out the purchases that aren't worth the effort. Step 2 is automating your savings. If unallocated money sits in your checking account, human psychology dictates that you will eventually spend it. Log into your banking app and schedule a recurring transfer. Route 10 to 20% of your paycheck directly into your savings or investment account and set it to execute automatically on your exact payday. Step 3 is applying a strict filter to the money you have left over to ensure you are accumulating the right things. This graphic shows the mechanics of assets versus liabilities. A liability, like a new car, takes money out of your pocket every month through depreciation, gas, and maintenance. An asset, like a dividend-paying stock or a rental property, puts money back into your pocket by generating a continuous yield. When you force a percentage of your income into savings and filter your remaining purchases toward assets, you eliminate human error entirely. The system builds your net worth in the background. Step 4 is the monthly check-in. Pick one specific day, like the 28th of every month, to review exactly where your money went over the previous 30 days. This chart shows the 50-30-20 budgeting rule. Your spending should divide perfectly into 3 categories: 50% for absolute needs like housing and utilities, 30% for wants like dining out, and 20% allocated strictly for savings and your financial goals. If your needs category creeps up to 58%, you have to find efficiencies. Breaking a year-long apartment lease is difficult, but calling your provider to negotiate a lower rate on your utilities or car insurance takes 5 minutes. Step 5 is your quarterly check-in. Open your net worth tracker spreadsheet, add up all your current assets, and subtract your liabilities. The resulting number measures your exact financial progress. During this quarterly check-in, pick one single bill that feels too high. Call the provider, state your loyalty as a customer, and politely cite a competitor's cheaper rate. If the first representative says no, ask to be transferred to the retention department. Tracking your net worth and negotiating bills 4 times a year instead of every month keeps you focused on the long-term trend. It insulates you from daily stock market volatility and prevents emotional burnout. Step 6 is starting your investments early. Routing just $50 a month into a low-cost index fund immediately initiates the mathematical process of compound interest. This graph charts the advantage of starting now. The blue line represents someone who invests $10,000 a year for 10 years, then never saves again. The black line is someone who waits 10 years, but then invests $10,000 a year for 3 straight decades. The early starter contributes $200,000 less overall, but finishes with a significantly larger final balance. Step 7 is creating save points. Map out specific, tangible rewards for your milestones, like a high-end dinner when you hit your first $5,000 saved, or a new watch at $100,000. Personal finance is a marathon. If you don't deliberately celebrate the milestones along the way, Your brain processes the entire journey as an endless grind, increasing the likelihood that you will eventually quit the system. By implementing these exact steps, you have constructed a system that saves your cash, filters out bad purchases, and requires minimal quarterly maintenance to keep running. That system provides profound peace of mind. Your wealth is now compounding through an engine that operates entirely in the background of your daily life. A built engine still needs the right fuel. Now that your structure is in place, you need to know exactly which assets to direct those automated savings into. Click the video on your screen right now. I'll walk you through the exact index funds and assets you need for 2026, ensuring your new financial engine runs at peak.